Well, welcome everyone. I'm here with Professor Kathleen Wright. Kitty, you're the director of our state and local program here at Golden Gate University. But boy, you wear a lot of other hats also, don't you?
Well, I do. From time to time, I sit on the Board of Accountancy and I do seminars for Cal CPA and write books and articles, and I'm now on the editorial board of State Tax Notes.
Yes, so certainly a highly qualified person to tell us what's happened in the world of tax. And we're recording this on November 9. A couple of things changed in the election, didn't they?
Well, November the 8th was not only a stunning upset in the major race that, of course, involved who's going to be our next president, but also on our ballot we had 17 propositions, and several of them had tax ramifications. So let me tell you a little bit about a few of those, and then we'll move on to some of the other developments.
Sounds great.
Probably first and foremost, and the one that will affect most taxpayers in California, is the fact that we did vote to extend what had been a temporary tax increase for another 12 years to the year 2030. That means that our maximum tax rate on the tax rate schedule for individuals, not for corporations, the rate remains the same, but for individuals, the maximum rate on the rate schedule is 12.3. Now, if your client does make over $1 million in taxable income, unrelated to the rate schedule and having nothing to do with the ballot proposition voted on yesterday, is an incremental 1% that's added on to the tax, and that would be added on regardless of whatever we did with the temporary increases, to bring the maximum rate up to 13.3. But the rate schedule maximum rate would be 12.3, then 11.3 and 10.3, and then down to the basic rate of 9.3, which is the maximum rate that we had for several years. Now, these rate increases don't kick in until a client's taxable income reaches higher levels. To give you an idea, $250,000 if you're single, $500,000 if you're married, and then the different categories of rate increase kick in at, again, higher levels as we go up the line. So be aware of that. The temporary tax increase is not going to go away. Now, bear in mind the proposition yesterday did not extend the temporary increase in the sales tax, so that will go down, but did extend it for the personal income tax, which was not a big surprise for California, but certainly a major issue for tax preparation and advising your clients.
Right, now that I'm an academic rather than a professional, I don't worry quite as much about the top tax rate, but same as last year for the 13.3 top rate?
The 13.3 is the top rate, which makes California, as we speak right now, the highest tax state in the nation. Now, over through to 2030, whether we remain the highest tax rate in the nation or not remains to be seen, but at the moment that's where we are.
Got it. What else changed?
Well, also yesterday we legalized marijuana, along with Massachusetts and Nevada. Those two states also legalized marijuana. Now, what that means is we are in a state, California previously had legalized the sale of medical marijuana. And when that occurred, which was now several years ago, there were issues that came out on the tax return, and I'll describe them very briefly because they are complicated. What we did yesterday, which is legalize marijuana for recreational use, eliminates one of the issues on the tax return that we had previously, but not the major one. But let me go on to say that this is going to generate a lot of revenue for California. I mean, that was one of the positive aspects, because there is a significant excise tax that's going to be imposed at the retail level on sales of this product. But apart from that, on the income tax return, if you have a client that decides they want to get into the business of selling recreational marijuana, then you would obviously have to report all the income, but we conform to federal law, Section 280E, under the personal income tax, but not under the corporate tax. Isn't that odd?
Well, and a little scary, right? Because doesn't federal law disallow deductions associated with an illegal business?
Well, Fred's a smart. Now, how did you know that, Fred?
My education went up in smoke.
Moving right along, what 280E says is that if you are, quote, a drug dealer, and of course at the federal level, marijuana still being a banned substance, if you sell it, you are for federal purposes a, quote, drug dealer, you can deduct cost of goods sold, but you cannot deduct the trade or business expenses like heat, light, and power and so forth of operating the store or the farm or whatever it might be. And we conform to 280E under the personal income tax. So if you operate your marijuana activity on a Schedule C or even in a partnership or an LLC or any of those forms of flow-through entity, you would be under that restriction, and that did not change. Now, going forward, the legislature could easily change it if they wanted to, but the proposition did not address that issue. It's interesting, though. If, Fred, you were to decide to get into this business, then if you formed as a corporation, you could deduct all your expenses because under the corporate tax law, which is a completely separate statute, we do not conform to Section 280E. So once you realize and understand and know about this, it's, I suppose, not all that difficult, but it's just a very odd tax structure.
So while Colorado and Washington went ahead of us, these are really big businesses, so a lot of our alumni, I think, are going to find there will be mainstream businesses coming to them for tax advice. And the short answer is dealing with marijuana is difficult because of the federal disallowance of the deductions. And what you're saying is you can give some really quick advice, which is, for Pete's sake, incorporate.
Well, at least that allows you the deductions on the state return. Now, on the federal return, you're still going to be under the restrictions of 280E. But what did change, by legalizing recreational use, it's no longer criminal. If you sell marijuana for something other than medical purposes, under prior law, that arguably would be an illegal activity. And if you engage, and if it were determined to be criminal, you would lose all your deductions. Well, going forward, now that we've legalized it, you would no longer run that risk. But you still have this difference in the statutory treatment that we just discussed.
Got it.
Move along. Doing business. How could we not talk about developments in the area of state and local without mentioning doing business? Do you know, Fred, that there is a case before the Ohio Supreme Court that is arguing that the cookies left on your computer by an out-of-state vendor is property of the out-of-state vendor that is in the state? Is creating nexus with that state and is going to result in that out-of-state vendor having to file. The state is Ohio, the taxpayer is Crutchfield. They are an online retailer with catalogs and things of that nature. So that case has gotten a lot of publicity, obviously, because of its unique arguments. But in California, we still have and are still uncertain about the situation where you have an out-of-state corporation that is invested in a flow-through entity like an LLC that does business in California. FTB takes a view, or has the opinion, that because the LLC statute allows you to manage the business, that whether you actually do or you don't, that you're deemed to manage the business because the statute says you can. Whereas in the partnership area, the state statute says if you're a general partner, you're responsible for managing the business. But if you're a limited partner, you don't manage the business. The LLC statute, under state law, in California at least, does not work that way. It says any member would have the right to manage. So we have, so the FTB decided that every corporate out-of-state member of an LLC was doing business in California because theoretically they have the right to manage the LLC.
Now, does it matter whether we're a member-managed LLC where all the owners get a vote or manager-managed?
According to FTB, your own personal articles of organization or whatever you would want to call it that would set forth the terms and conditions under which this LLC would operate is not relevant. What's relevant to them is the statute. Now, this has been litigated, and the taxpayer won. The fact pattern was great to test this issue. It was a small investment, $50,000, when the LLC was an investment vehicle, so it's like a mutual fund in a lot of ways. And so this out-of-state company only invests $50,000. They have less than a 1% interest, and they get a notice from the FTB that in a year when the LLC lost money, that they should have filed a tax return and paid $800. And they challenged it, and they won at the lower court level. Of course, the FTB appealed, and the appeal is still sitting there. And as a lower court decision, it's not binding on anyone but the parties involved in the case. So, case to watch and a big issue. And as I understand it, FTB is still sending out these notices.
And even if it's investment activity, normally you'd expect that investment activity, you'd pay tax in your home state, and it would be business activity that would taint you.
It's not so much. It's not so much the flow through of the income as it is in a year when the LLC would lose money, that you would still have to file and pay $800 because you're deemed to be doing business here.
Got it. Yeah, I'm having trouble with where the business is.
Yeah, I am. So is the taxpayer. So is the taxpayer. But that is still an issue, and have to wait for the appeal. Well, we need to talk about apportionment. I mean, if you can't get away again from state and local, I told you I was going to go on.
Right. Nope.
If you turn the key in the back, I was going to keep on going. Real quick on apportionment. This might not affect all that many of your clients if you're in California, but it's a hugely big issue nationwide, really. The case involved Gillette. Gillette is not a California corporation, but they do file here. And they argued that they had the right to continue to use a three-factor evenly weighted apportionment formula because California was a member of the Multi-State Tax Commission and had adopted the Uniform Model Rules called UDIPTA, and those rules were in agreement with the other member states that California, the purpose of the MTC is to try to get all the states to do things the same way.
Right.
Apportion, business income, all of that. And when we became a full member of the MTC, which we did way back at the beginning, we entered into this contract with the other states that we would adopt and make available these model rules. So we changed our apportionment formula to three-factor formula double-weighted sales. This is for the years involved in the litigation. Gillette says, no, we still get to use the three-factor evenly weighted formula and all these arguments about contract clauses and all this kind of thing. California Supreme Court, so the case goes back and forth and back and forth. Finally gets to California Supreme Court. California Supreme Court said, nobody thinks this is a contract. Nobody ever thought that by becoming a member of the MTC, we bound the hands of our state legislature and essentially told them, we can't do anything anymore. We can't change anything. And therefore, we are going to uphold the state. And Gillette, essentially, your argument is interesting, but we're not going to go that direction. Gillette appeals to the U.S. Supreme Court. U.S. Supreme Court refuses to take the case. Comparable litigation in about 5 or 6 other states going on right now, and the case in Minnesota involving Kimberly Clark is going to be appealed to the Supreme Court. So we might not have heard the end of this, but I think if the Supreme, what do I know about the Supreme Court? But I think that if the Supreme Court turned it down once, they would probably turn it down again.
Until you get a conflict among circuits or something like that where they have to take it, right?
Yeah.
So for the moment, when states reach out and try to attack companies that really don't have much presence, using the argument, no, you promised other states you wouldn't do that, isn't working.
No.
Do you hear anybody arguing against all these market-based sourcing rules, the economic nexus stuff? Because that's where I really felt taxpayers would come forward aggressively.
Very aggressively. Very aggressively. I have myself seen and read numerous articles, at least with California, where practitioners are sitting back and going, I never realized how much benefit the convergence of a single sales factor, Finnegan throwback, which I'll define in a minute, and market-based sourcing would have on my clients. And their apportionment percentage has gone from like 23% down to 12%.
Right, so we're being nice to the people who have their employees in their plant here, and we're being mean to everybody who sells to our residents, right?
We are yes. We are effectively, I mean, the result or the ramification is that the apportionment very likely for an in-state corporation will go down. It is interesting because this only became mandatory in 2013. So from a big picture perspective, as far as tax collections at the state level, looking at it at that macro, looking at the macro view, so to speak, we don't really know yet. I mean, from what we see in the cash flow that comes coming into the state, we're ahead of budget. We have been ahead of budget for the last 2 years, and this next year looks pretty good for California. And so we haven't really seen, but then again, the big chunk of the state's revenue is the personal income tax. Corporate tax is a very small piece of the revenue pie. Right. It stays pretty constant. It doesn't move that much. And the fact that Silicon Valley corporations benefited greatly because with that market-based sourcing, all that revenue that rolls into the South Bay, so to speak, from patent licensing of their patents is now sourced out of the state.
Exactly.
Yeah. And it used to cost of performance, it used to all come back to California.
Right. Now, if individuals are residents in the state of California, tough luck, right? You can't use the apportionment. You pay tax on 100% of your income, maybe get a credit for other states. But because of the residency for individuals, we don't see the benefit. Our corporate clients are the ones where we see the benefit?
Including S-Corps, because S-Corps pay the franchise tax at the entity level.
Mm-hmm.
So they would apportion just like a C-Corp, so they would get the benefit. Apportionment, you phrased it exactly correctly, and I'm really only repeating what you just said, which is that trade or business income that would flow through to an individual, either from an LLC or that would be on a Schedule C, is apportioned. That is true. But the effect of the apportionment is not on the amount that they report on a California resident tax return, which is going to be 100%, but rather through the amount that California will allow them to claim as a credit for tax paid to other states, which is based on the amount of income that California law sources to the other states. So that's how apportionment plays through all this. And boy, did we have a case on credit for tax paid to other states from the Supreme Court last year, and we're still trying to figure out the ramifications. The Wynne case?
I don't think I read it.
In Maryland? Oh, my goodness. Mr. Wynne owned an S-Corp that did business in, I'll be very brief, but boy, it's just chock full of language that offers all kinds of opportunity. Mr. Wynne was owned an S-Corp, did business in about 30 states, so he's filing 30, because it's all flowing through to him, so he's filing 30-some-odd tax returns, claiming the tax paid as a credit against his Maryland tax liability. Mm-hmm. And the way Maryland assesses their tax on the state income tax return is there's a state tax and there's a county tax. Now, you just fill out the state return and pay whatever, but not really probably realizing there's a state and county component to it, but that's the way they assess tax. Okay. So he claims a credit against the entire Maryland tax. Maryland says you can claim your credit against the state portion, but not the county portion because it's a credit for tax paid to other states. Well, Mr. Wynne decided he was going all the way to the Supreme Court, and to the surprise of everybody, they took the case.
Wow.
Now, the opinion. The opinion says, number one, the majority. Now, there was a minority. Justice Scalia was alive at the time, and if you want entertaining reading where Scalia was at his best at skewering the majority opinion, this is one of them. But the majority opinion says, We don't see the difference between city taxes, county taxes, or state taxes. You pay state tax, they give you a credit, you ought to get the credit against all of it. Well, we don't give a credit for New York City tax. We never have. And we were not giving a credit for the Maryland County tax either, because we would limit the credit just to state tax. So there's that. The second aspect of this is the majority goes on to say, you know, we don't really even understand the difference between a net income and a gross receipts tax, and reaches the same conclusion. You know, we really think that all of those taxes ought to be eligible for credit against whatever state tax you're paying in your home state. At least that's the way we feel, as long as states keep taxing 100% of the income of residents. So FTB keeps saying, when we ask them, what's the impact of Wynne on California, FTB keeps saying, well, we're working on it.
Got it. Or do you see people filing protective claims right now if they paid a lot of tax in New York City to other jurisdictions?
I've had the question several times. I've told practitioners that if it's an aggressive claim, I mean, explain the risk, because FTB would disallow it, I'm pretty sure, the way things stand right now. And I don't think, Fred, that there's any state that's going to give up voluntarily all of the tax credits that the Wynne case implies should be available.
Yeah, I might want to just do a protective claim and keep my old statute open, right?
Yeah, that would be an option. Let me tell you one or two other real quick things. We did apportionment, we did nexus, we talked in general about market-based sourcing. I do want to say just one or two quick things about employee benefits, and then...
Please.
I've probably talked too much.
Never.
The state of California did enact legislation that raised the minimum wage in California up to $15. Now, it phases in. It's not going to happen all at once. It did preserve the rights of cities and counties in the state of California to enact their own minimum wage legislation, which we have done in San Francisco, and so has LA. So we're gonna hit $15 in the city before the state would hit the $15 benchmark, but that's a big development. The other big development is we now have California Secure Choice.
That doesn't sound very secure.
And what that says, what that legislation says, is that if you have 5 or more employees, you are required to have a pension plan.
Wow.
Now, let me explain. I did that so I would get that reaction. I would get everybody's attention. Now, let me explain. The form of the plan that you would be required to have would be a payroll deduction IRA. So that would mean the employees would set up their own IRAs. The employer would be required for setting up the payroll administration process of deducting 3% of the employee's salary out of their wage and transferring the money over to the IRA account for the employee. So it's not benign to the employers. There's no requirement for an employer match or anything like that. However, there is the administrative requirement of setting it up and explaining it to the employees. And further, the employer has to start deducting the 3% right up front, day one when the employee is hired. The employee can opt out, but that's why somebody's got to be there to explain it to them so the employee knows what is going on, and if they choose to opt out, they're fully informed. So that's now statutory. It's Senate Bill 1234. Now, it probably won't get started. It phases in. So it phases in first for employers with 100 employees, then 50, and then we get down to 5. The program doesn't start until the first person is enrolled. And the state says, it's going to take us a while to get this set up. And so it may be about a year or so before we actually see this roll into the workplace, so to speak.
Got it. So if we're using a payroll service like ADP, presumably they'll have the support for it to automate the process. But it sounds like the employer, if they're doing their own payroll, they're going to have to deal with the administrative burden, and no matter what, they're going to have to talk to their employees about it.
Absolutely. Absolutely. The idea, we enacted legislation to study this 3 years ago, and they appointed a board, and that's what the board's been doing. Board needed a ruling from IRS that said it would not, these plans would not be subject to ERISA. They got it. And they also needed a ruling from the Department of Labor that dealt with the Department of Labor's involvement with ERISA, and they are really the prime agency on ERISA, so they got that ruling. Then the board, this little board, sent a letter to the state legislature earlier this year, 2016, telling the state legislature that they were ready to go ahead with the program. And it does have appeal, particularly, for a Democratic legislature, it does have appeal because it takes one small step towards ensuring that everybody's got something saved for retirement, so you don't end up having to be funded by the state when you get to that point.
Got it. So we're paying more money to the state of California in personal income tax. We're paying more money in cigarette taxes. If we prefer to smoke marijuana, we're paying a whole bunch of tax right there. I vaguely recall that some cities and counties are now taxing sodas as well.
Oh, yeah. We, yes, we enact, thank you for that one. We enacted what do they call sugar tax, I think they call it.
Right.
It's a form of excise tax on, now how you define a drink that is a sugar drink, I'm sure is going to be interesting reading. But
Exactly. And in short, 2016 will go down as a year where state tax had a very simple formula, more.
And he did that off the top of his head. I'm impressed.
Kitty, thank you very much.
Well, thank you, Fred. Thank you for sitting down with me, and I hope you got a little bit out of your California Minute. And if you have any questions, please feel free to let us know, and think about our program. We talk about all these interesting issues, really interesting issues, in a wide variety of state and local classes. So I hope to see you there. Thank you.
Thanks, Kitty.